Revolutions happen fast. They can incubate almost unnoticed for years, and then pop. The next thing you know, it's New World Order. And so it is, it seems, with the ESG revolution. Once an ideology on the fringe, investment strategies taking into account environmental, social, and governance factors are positively blossoming. A new BNP Paribas survey shows, for example, that 2/3 of money managers and asset owners align their investment framework with the UN's Sustainable Development Goals. And why? Because there's alpha in ESG. And, quite likely, even the opportunity to create a more just and sustainable economic order. Sooner than you might think, ESG is set to become the investing norm.
You're listening to the Ticker Podcast from IR Magazine, a roundup of this week's leading stories and industry comment from the world of investor relations. Here's your host, Jeff Cossette.
Hi, everyone. My guest today is one of the catalysts behind our impending new normal. Over the course of the last 2 decades, he's had literally thousands of conversations with corporations on a wide range of social and environmental issues. First, as head of shareholder and public policy advocacy at responsible investing pioneer Domini Impact Investments. And now, in his newly created job as head of Stewardship Americas for BNP Paribas Asset Management. Few have more experience or influence in helping companies evolve their ESG habits. And now, in an era of acute systemic risk, he's expanded his field of operations to improving overall system conditions at loftier levels, including the supply chain. On today's Ticker Podcast, Adam Kanzer on why the fringe has gone mainstream.
The risks that we were warning about 20 years ago, are coming true.
All that and more coming right up after this week's IR News Update. There's been a big fall in the global IPO market. Capital raising fell almost 40% in this year's first half compared with the same period in 2018. Data compiled by law firm Baker McKenzie shows about $70 billion was raised across 514 IPOs. That marks the lowest for value and volume since 2016. The U.S. federal government shutdown, continuing trade tensions between the U.S. and China, and the ongoing Brexit saga all contributed to a slower market performance, according to the firm's analysis. Infosys took away 2 gongs at the IR Magazine Awards India earlier this month. The IT consulting firm won prizes for Best Large Cap IR Team and for Best Use of Media and Technology. The awards, which were well spread across a range of sectors and companies, also saw Telecom Bharti Airtel's Komal Sharan win the award for Best Large Cap IRO, while the Phoenix Mills' Varun Parwal won for Best Investor Relations Officer in the small to mid-cap category. More evidence investors want better ESG reporting. A group of big institutions with combined assets worth over $10 billion is pushing for greater transparency at companies it sees as having high levels of environmental impact, but low levels of disclosure when it comes to issues like climate change, water security, and deforestation. The group, which includes the likes of HSBC Global Asset Management and Amundi, is targeting more than 700 firms, including BP, Amazon, and Volvo. The campaign is calling on companies to disclose environmental information through CDP, a nonprofit global environmental disclosure platform. Both the number of investors signed up to the campaign and the number of companies targeted have grown notably in recent years. In 2017, CDP's non-disclosure campaign attracted 57 investors and targeted 416 firms. And finally, evidence that some companies are increasingly keen to supply ESG information. IR Magazine editor Ben Ashwell caught up with Sally Curley, founder and CEO of consultant Curley Global IR, at the US IR Magazine Awards earlier this year. Curley, who won the Lifetime Achievement Award, had advice for aspiring IR professionals and offered a window into the sort of help her new IR clientele was seeking.
I think the first thing that comes to mind is to be true to yourself. It's a very difficult profession, and often you can question you can question yourself, especially earlier in your career. Be true to yourself, trust your gut, honesty, integrity, tenacity in a lot of situations, and leverage the support network. This is an amazing, investor relations is an amazing profession. It's an amazing group of individuals, and I think, I wouldn't have gotten to where I am today without the support of quite a few people. So I would say leverage those individuals.
Sure. Now, you've recently contributed several articles to IR Magazine and Corporate Secretary on ESG, and they've been fantastic articles.
Thank you.
And so what kind of work are you doing now around ESG and the kind of work that you're doing with your clients?
It was interesting when I retired from corporate 2 years ago to hang out my own shingle. It was the thought that we would have my business partner and I would have a three-legged wheel, and that would be investor relations, corporate sustainability or ESG, and corporate governance outreach. And because that is what I had done for many decades, and that's what her experience had been for many decades, I expected it to be mostly investor relations. I would say that 75% of our clients are ESG related, or corporate sustainability. It's actually been quite interesting.
You can find a range of red carpet interviews with award winners on IR Magazine's YouTube page. A friend once told me the story about wildebeest. It's tough being a nomad herd animal on the vast African plain. Once you've found a watering hole, you don't want to stray too far, or linger too long when in search of nearby food. You see, for a herd, timing is crucial. Leaving a feeding ground to go back to the watering hole, which could be like 30 miles away, too soon means some animals won't have eaten enough. Leave too late, and some could die of thirst before you got to the waterhole. You gotta have a system. Wildebeests, it turns out, possess what is known as swarm intelligence. They can act as one. But when? And how does everybody know? Wildebeests do have a kind of leader, but deciding when to come or go isn't their job. Okay, so somebody actually watched a wildebeest herd. And it turns out that when, say in a herd of 100, the 51st wildebeest turns their body toward the direction of the watering hole, everybody stops eating and heads back. All at once, no argument. If you think about it, it makes sense. Doesn't even matter if it's true or not. And now, remember that BNP Paribas survey of institutional investors I mentioned at the top of the show? Another question it asked was about how much of their funds would be allocated to ESG by 2021. Now consider 90% of about 350 of the world's biggest money managers and asset owners predicted that more than a quarter of all their funds would be allocated towards ESG by 2021. Of course, that's just an analogy. I'm not saying investors or corporate management are herd animals, but I do think we are at or near an inflection point. So I began my conversation with Adam Kanzer by asking him how we got to where we are.
We're at a point now that people are suddenly paying attention. What's changed, and why has it changed?
Well, it's changed. First off, I just want to reinforce, I agree, it has changed dramatically. And so I started in this field in 98. I was fortunate to come in at a time when investors that were talking about sustainability were, to be polite, were essentially seen as freaks. There was, people didn't know what to do with us. The other investors didn't really even know what to make of us. The corporations didn't generally know what to make of us. And at best, I'd say, we were tolerated. So we learned how to be very persistent. and to continue to push and to continue to develop our arguments so that we could speak their language. You can't simply go in and make a sustainability argument. You have to make a business case argument. You have to translate these issues into the business case. And I think, as a field, generally, I think we got better and better and better at doing that. If you jump forward, we're at a time now when I think it's really fair to say that sustainability issues, or however, whatever term you want to use, have gone mainstream in the investment world. And I say that because some of the largest investment institutions in the world, pretty much all of the largest investment institutions in the world, are working on sustainability issues to one degree or another. The intentions are different, the depth of experience, the depth of expertise is different, but everybody's doing something. And I think if you ask them, and I gave you an honest answer, I think many of them are doing something on this because of client demand, because of changing regulations, and because the risks that we were warning about 20 years ago are coming true. There used to be kind of long-term risks, and some of these risks, like climate change, are now current risks, in-your-face risks that are so large that even mainstream investors can't ignore them, central banks can't ignore them. Those are big risks. It would have been nice if we'd gotten more dramatic responses 20 years ago, and it would have been easier to fix it. It's concerning that you have people like Mark Carney feeling the need to speak about an environmental issue.
Climate issues are relevant from a monetary policy perspective to the extent they impact the forecast, the path of the economy and inflationary pressures over the course of the next few years. The tragedy of the horizon is that if you rely on when it becomes relevant for monetary policy, it will be too late.
Those issues shouldn't be so large that they become a threat to financial stability. I'm thrilled that he has. I mean, he's taken tremendous leadership on this issue. But it's kind of a sign of how bad the problem is and how long we ignored it, that it becomes something that central banks are worried about and financial stability regulators are worried about. So part of the reason why the attitudes have changed is because the risks are now more apparent.
What would be holding back those investors who do not integrate ESG thinking?
I mean, hard to speak for them, but I can speculate. Part of it is that this is changing as well, but it hasn't really been part of the traditional training and education of investment professionals, which is why back, in the late 90s and before that, when investors started raising these questions, people just didn't know what to do about it. They didn't know how to respond. They didn't know whether it was appropriate to respond. They didn't know how to categorize these issues. I mean, I think you still see some of that. You still see, aren't these political issues? They don't really know exactly what box to put it in. So part of it is that it's just not simply in the toolkit. And it's not on the list of things that the typical investment professional has been trained to think about on a day-to-day basis. It's not necessarily that they're opposed. It's just they don't consider it to be their job. That's changing. And it's changing, I think, because the nature of the risks are changing. And I guess also because client demand. But I think the risk consideration is really driving things. And, if the skeptics didn't see money in this, or at least avoidance of loss, they wouldn't be doing it. So I think that's always what's going to lead practice. It's going to be the hard numbers and the realization that these are real issues. And you have to think about them. And I think also that a lot of folks in the investment field see that I want to get ahead of this. If I can consider factors that the rest of the market is not looking at, I may be able to get an advantage.
You're listening to the Ticker Podcast from IR Magazine, the sound of global investor relations.
So, the radical necessity to change things is manifest. And as fiduciaries, Kanzer believes asset managers of all kinds are uniquely positioned to oversee a shifting investment paradigm.
Yeah, I mean, there's a philosophy on the passive side that would say, well, yeah, I'm not paying you to make those kinds of decisions for me. I'm paying you to track the market. But on the other hand, you're invested in these companies for the long run. You can't sell them. Whatever risks they face or whatever risks they cause, you own. And it's incumbent upon you as a fiduciary to deal with them. And it becomes a beta strategy. That term beta gets thrown around a lot and means a lot of different things. But a lot of what we're doing is trying to change and trying to kind of improve the overall system conditions, the overall health of the market, as opposed to going in and trying to fix an individual problem at an individual company. We do that too. That's part of this work as well. But a lot of it, and I think kind of the more interesting work, is more systemic. And that's where you get involved with public policy initiatives and speaking to companies about their externalities, about the harms that they may be causing that may not be coming back to bite them. It may not be affecting their stock price, but it does affect the overall health of the economy, and it does affect, in some way, your portfolio as a whole. And which is a different way of thinking about things for most investors, I think.
I'm surprised that actually resonates with people. That lack of that beyond self-interest. I guess they're looking at the whole pool kind of deal.
Well, it's not necessarily that it's beyond self-interest. If you're a broadly diversified investor, you're buying a large basket of stocks, right? You're invested in the market. If the market is heading south, that's you own that, right? If the market's not stable, you own that. If there are companies in your portfolio that are having an outsized negative impact on overall market conditions, why not try to work to fix that? So there is a self-interest to it because it still does affect your overall performance, and it affects, the value that you're trying to deliver to your clients. It's just looking at it from a broader perspective, not stock by stock by stock. I'm still struck by how often you hear analyses about sustainability issues that are really just looking at the individual stock. Well, how is it going to affect this company? Well, it might not affect this company, but it's affecting every other company that I hold. So that's a problem. Don't I have to worry about that? Weren't we all taught to diversify our portfolios? Well, that's what we've got. We've bought that kind of broader risk. We need to think about those implications as well. It's been a long-term struggle, I think, to get away from this idea that this is about charity or it's about, altruism or, some form of philanthropy. The whole field, I think, of responsible investment has sort of been dogged by that for a long time. Well, yes, there are some people that want to give up some return in exchange for, some benefit to some third party. And there are some folks out there that are willing to do that, but that's not what this is about. As fiduciaries, we don't really have that option unless, of course, we have a client that comes to us that says that's what we want. Most clients don't. What they expect is they want, market rate returns. They want us to help meet their financial objectives. And we have to, in the course of doing that, we've got to manage whatever risk comes along. And we recognize that there's a broad range of risks that folks have been calling extra financial or non-financial, but at some point they are financial or they're economic. They're broader. Our actions and the actions of the companies in our portfolios and the other instruments in our portfolios have an impact on that. They either affect those risks, they either help create those risks, or they mitigate those risks, or they're impacted by those risks. That's just part of the package of things we have to worry about. And I think part of the thing that had got lost definitely in the early years, but I think is now becoming, I think, more well understood, is that if you are an ESG manager, a sustainability manager, if you're looking at sustainability issues, you're still a fiduciary. Your obligations are the same as they were before. You still have to manage all those other financial risks as well. It's not one or the other, it's both. And actually, as a fiduciary, I'd say you have an obligation to think about these other issues, these broader issues that either may impact portfolio returns or may impact the welfare of your client and may impact the welfare of the economy that you live in. I mean, the economy provides a significant portion of the returns that we end up delivering. So we have to worry about those things. You know, the companies get that. This is why the companies spend so much money on lobbying. You know, they know that the system conditions matter for their business long term. They don't always have the right perspective on which system conditions, you know, matter and why they matter, but they know it matters, and they're heavily involved in that. Investors have been more on the sidelines, sort of feeling that that's not our job. We're just simply supposed to manage risks. We're not supposed to try to influence things. And I think that attitude also is somewhat changing. I mean, the way that we're phrasing it is that you're either a future taker or a future maker. And the traditional view is that investors are future takers. You think about the future and you prepare for it. You hedge against certain risks and you invest for certain opportunities that you might think you may think will come to pass in the future, based on your analysis of the way the future is. But you don't have any influence on the future. It is what it is. All of us, in some respect, are future takers. We have to be. That's part of the job. But this future maker concept says that the decisions that we're making are also having an influence on future outcomes, that we're making choices about the future. And that since we're making choices about the future, we need to be making the right choices. And we need to try to shift things in the right direction for the benefit of our clients. You know, you never get outside that role as a fiduciary. Our first and last obligation is to our clients. We need to keep their best interest in mind. But the future that we're looking towards needs to be the future our clients want to live in, and they don't want to live in a 4-degree world. That's an uninvestable world, and it's an unlivable world. So it becomes our obligation to do what we can to shift things in the right direction. And part of what comes from that is that we actually have influence, and that decisions that we're making actually do affect outcomes in the world, and always have. It's just that investors haven't really been paying attention to those outcomes, and so what you end up with is massive allocation of capital to fossil fuels, which we now know most of which we have to leave in the ground if we're going to avoid disaster. Well, that wasn't very good long-term planning. We essentially we wasted a really critical resource we could have been using much more efficiently and much more intelligently, but we burned up our allotment. We came pretty close to exceeding our carbon budget to keep the Earth, under 1.5 degrees. So that's a consequence of not paying attention to the future. Investment used to be about creating some kind of value in the real world. It's not simply based on what happens in your portfolio. You put money into something because you expect it to grow. That's what investment, that's the kind of the core meaning of investment, right? So when did it be, at some point along the line, it became kind of foreign to the investment process to actually think about the thing you're investing in and what the outcome is going to be, which has always been kind of absurd to me,
Yeah, but of course, up against that, there is a theory that companies have a short-term orientation to market. Mm-hmm. A lot of corporate management will say, no, it's not us. We have a long-term view on markets. It's the investors that are forcing us to have a short-term market. But whatever it is, there is that blockage there somehow. And maybe something as simple as their pay being, tied to the next quarter or whatever. When in fact, what we're talking about is thinking longer term for everybody. Is it enough to go to every company and say, look, there is a market answer to this, or does it at some point go beyond that and regulators literally have to get involved and say, well, you guys aren't pulling up your socks quick enough?
Yeah. Well, regulators, of course, have to be involved. I mean, and always have been, right? I mean, there's no such thing as a truly free market. What you want is a well-regulated market, and that's for the most part what we have. When the market has failed, it's often been because of lack of regulation. The short-term piece, so that's harder to regulate, right? Because part of it, I think it's true that a lot of it is investors. I've always thought that investors are at least half the problem here. Too many investors have been pushing for very short-term results and, really focused on the next quarter and, punishing companies that miss their earnings target by a penny or a quarter of a penny. It's ridiculous. But that's where things went, and you can't completely blame corporate executives for managing to that if they're going to get punished for not doing so, right? And then we decided to align their pay with investors, and if investors were short-term, then of course you're paying the managers to think short-term as well. So there's definitely, I think, a lot of truth to that. And I have spoken with some, executives over the years that have bemoaned the role of the investor and the quarterly earnings call and the messages that they're getting, which they think add really no value because what they're trying to do is manage an enormous enterprise for the long term. And it doesn't help to be thinking about the next quarter. So we all have to kind of think about how do you shift away from that. The underlying problem, I think, is just it's human nature. It's very hard to think about the long term when you've got bills to pay now. And you got things that you can measure now. The risks become more and more uncertain the farther out that you look. So, it's not surprising that we've come to this. It's just that when you can raise such significant risks that are clearly going to come to pass because the science tells you that it's going to happen, and you still don't take action, well, that seems like a whole different problem. and that is that's a harder nut to crack. If you know that you're facing disaster without changing course, and yet you still maintain the current course, there's probably stronger words than are appropriate for a podcast for that kind of thinking.
Right. Or you're just not changing fast enough. So what would you like the SEC and regulators and what would you like to see in terms of them? Reporting is now pretty voluntary, essentially, right? There's no particular standards. There's no.
Well, there's materiality, right? Which is in the eye of the beholder, and it's an ever-changing concept, and the bulk of the reporting, or the heart of the reporting is governed by materiality. There's also all sorts of, very specific requirements that you've got to, very specific things you've got to disclose. I do think that the disclosure regime kind of needs a bit of a rethink. We do get a lot of valuable disclosures through voluntary reporting. There's no question that, the quality of the voluntary sustainability reporting, I think, is valuable, and it's gotten better over the years. That doesn't mean that every company is on a par with each other, and that's part of the problem that investors have faced. Yes, there's tons and tons of sustainability reporting, but it can often be difficult to compare them to each other. Even, within industries, you'll still have companies where, two peer companies, one will be doing a very good job, very thorough report, and the other does nothing. Mm-hmm. And so if you're an investor that has to compare the two of them to each other, what do? That presents real challenges, and that's the kind of situation where you'd like to see a regulator step in and set at least some minimum standards. There's a downside to that too, which is that if you get if they go too far, you end up with a lot of boilerplate disclosure, which is what we have in many respects in the required reporting. So there's a tension there. The SEC, I think, put out back in 2010. They put out some, I thought, excellent guidance on climate reporting. And they didn't change the rules. They essentially said, look, this is the framework we've got currently. This is what materiality means. This is what the MD&A looks like. If you want to think about climate change, here are the kinds of things that you might want to report. It's your decision. You have to figure out what's relevant to your business, but this is kind of a framework for thinking about it. And very little happened. Very few companies took up that opportunity, that invitation to report. And I was on a webinar with one of the SEC staff that drafted that guidance, and he said, look, you could take any sustainability issue you want and kind of plug it into that same analysis because we didn't change the rules. We're just explaining what does materiality mean in the context of climate change. So you could say, what does materiality mean in the context of human rights or in the context of water or, any other sustainability issue? We're just picking this one, particularly significant one. The companies didn't really take that up. And to me, that said, you need rules. When you don't have a specific rule that says, right here on this line, this is where you need to put your Scope 1 greenhouse gas emissions, and here's where you got to put Scope 2, and here's where you got to put Scope 3, and here's where you got to list your goals and your objectives and your plan for getting there. If you don't have those specific requirements, you're never going to get every company to do it. You'll get some companies to do it, and some companies are doing it. A lot of companies are doing it, but you're never going to get them all. And the companies that have the poorest performance on sustainability issues are going to be the ones that will never report because why would they? Right. They're not required to, and their performance is lousy. So, if you had an option between reporting great stuff or reporting not so great stuff, if all you got is not so great stuff to report, you're gonna stay quiet. That's just rational behavior, right? So, to a certain extent, you do need regulation to set a floor and to increase the amount of information out there. The problem, I guess, is if you're going to have some baseline requirements about what gets disclosed, what's the basic requirement to be disclosed, and then what's within the company's discretion to disclose, that's where it becomes a difficult conversation. That's where, you need to think long and hard about it, because a requirement that's not the right requirement, it drives behavior, and it could drive the wrong behavior. So you want to make sure that, you've got the right indicators. And I think I don't think there's a lot of investors that are going to the SEC and saying, here's 150 things that I want you to require. The SEC took a look at the whole Reg SK piece a few years ago, and they had a very lengthy set of questions they put out for public comment, and there were just a few pages in that huge release that was focused on sustainability, that asked, what should we be doing on sustainability? And they got a flood of responses just on that few pages in this enormous release. A lot of investors wrote in and said, we need better sustainability disclosure. They didn't all agree on how to do it. They didn't all have the same model in mind. Some said it should be principles-based. Some said it should be rules-based. Some, there should be line item disclosures. Some there shouldn't be line item. There was debate. But the overarching message was investors need this information. They use this information. It's valuable information. We need the SEC to do something about this. I think investors would be thrilled if there was a formal process at the SEC to think this through. Rather than try to figure out up front what the perfect solution is, I think more about kind of let's go through a process and let's get opinions out on the table and let's see what works and what doesn't work. I just think it's clear that for whatever reason, and there's a lot of reasons, when it comes to sustainability issues, voluntary can only take you so far.
Let's back up a little bit and talk more specifically about you and BNPP. Beyond, I guess you lobby with the SEC and governments, and you speak to people like the accounting standards boards and stuff. But how specifically is sort of BNPP a catalyst for change, and how you're going to be changing BNPP?
Yeah, sure. And I should mention that we put out a global sustainability strategy about a month ago that outlines our kind of 3-year plan for building out sustainability across all of our assets globally. There's a lot of stuff in there, so I'll only give you a few of the high points. But first off, it's important to recognize, I think, that BNP Paribas Asset Management has been at this for a long time. We were founding signatories of the PRI, and we had SRI funds before that. Sustainability has been an aspect of our business for a very long time. And particularly in Europe, in terms of, you asked for how are we a force for change, been very involved at the policy level on sustainable finance issues at the EU, and very involved in engagements with companies in our portfolio for many years on a wide range of sustainability issues, from deforestation to climate change to animal welfare to a whole host of issues. What's new is, one, having this global strategy and a real commitment to have an ESG component in every single thing that we do across all asset classes. So that's a plan that's currently underway, and it's discussed in that document. In addition to that, we're building out our stewardship strategies globally. So my position as head of stewardship for the Americas is a new position. We also just hired a head of stewardship for Asia, which is also a new position. Stewardship historically was managed out of Europe. And, you can engage globally, but they needed somebody who's really on the ground in these other regions to really pick that up and build it out. So we're in the process of doing that. And so some of the commitments are going to be some of the same things.
Unpack that a bit. What do you, as head of stewardship, what do you do in the Americas?
So it's a great word, isn't it, stewardship?
Yeah.
So it's engaging with companies in our portfolio on sustainability issues and governance issues. It's voting our proxies for the companies in the region, and engaging in public policy work on sustainability, which are essentially what I've done throughout my career. Those are the kinds of the things that I focused on, and we're coordinating with each other to ensure that we have a consistent voice globally, and that we're moving forward on the commitments in that strategy. And the strategy also outlines there's 3 key kind of thematic pillars, which we're calling the 3 E's, which is the energy transition to a low carbon economy, environmental sustainability, which is largely, at least in the document, going to be focused on deforestation and water issues. And the third, which I think is kind of the most interesting, is equality. And thinking about equality from a lot of different perspectives. Largely conceived, it's about kind of wealth and income inequality, and how to address that, which we see as a very significant systemic risk. To, at a corporate level, questions about sustainable capital allocation running from the CEO all the way down to your supply chain. How does the board think about those issues? How should we as investors think about those issues? How do we think about the CEO to median employee pay ratio? What's appropriate? What's an outlier? What's not appropriate? How do we bring these issues down into the supply chain? How do we think about the role of share buybacks and corporate tax avoidance? And, that all kind of, and human rights issues fit into there as well. So it's a lot of issues, but with a thematic focus. And as I said before, the document also makes it very clear that we're seeing ourselves as future makers as opposed to future takers, that we're going to we're going to have a point of view. We're going to try to advocate to move things in the direction of these three E's, because we see those as, the kind of necessary pillars of a sustainable economy. And so as investors, we want to try to build a sustainable economy. But the alternative is unacceptable.
Kanzer mentions supply chains. BNP Paribas is one of a small but growing number of banks that will structure supply chain finance deals so suppliers get incentives to improve environmental, health, safety, and humanitarian standards. More and more companies are focusing on sustainable supply chains, and one of the issues that has come to the fore is the question of how migrant workers are treated.
So this is when a worker leaves their country because there's, due to a lack of economic opportunities. They hear about some great job in Malaysia, let's say, and so they leave their country, they leave everything behind, they go to Malaysia, they get there, and their passport and all their travel documents are locked in a vault that's controlled by their boss, so they can't leave. And they discover that they've racked up all of these fees to the recruitment agency that got them there, and it's going to take them 6 months to a year to 2 years to pay off the debt just for their job. So essentially they're working for nothing. And in some cases, the job isn't the job that they expected. It wasn't the job that was advertised. Those are kind of in the worst situations. They're in just really unacceptable situations which risk their safety and their health, and they're essentially working for no pay. So we're taking this to companies to say, okay, are you aware of this issue? Is your supply chain exposed to migrant workers? Do you have policies that ensure that workers don't pay for their jobs? It's an initiative that was launched by ICCR, the Interfaith Center on Corporate Responsibility. And, the good news is some leading companies have really taken this up and recognize that this is kind of a fundamental issue for them. So Coca-Cola, for example, has been a leader on this. Apple has been a leader on this and has been reporting for a number of years the amount that they have required their suppliers to reimburse workers. So they just came out with their latest supply chain report, and it's something like $30 million over the past, I want to say like 5 years or so, that's been reimbursed to workers. So they're taking it very seriously. We are finding, though, that there are some companies we're speaking to that don't really seem to be aware of the issue and don't have the right policies in place. So there's a lot of work to be done on that. And, put that under the pillar of equality. It's about equality of opportunity, and nobody should have to pay for a job.
Indeed, everyone would agree with that. But to play devil's advocate, why do they care? Getting back to the business case, these people are units of production.
If you treat them as strictly as units of production, I can understand why you wouldn't care. But if you want them to be productive and you want them to be healthy, you do have to care. And, if you worry about your consumers finding out about this, you need to care about it.
Okay. Yeah.
But I have found, though, that when you raise these issues with companies and you explain the conditions that these people find themselves in, most companies are not going to ask you to go through a cost-benefit analysis and help them make the business case and prove that they're going to make more money and that their supply chain is going to be more productive, et cetera, et cetera, et cetera. They just see it as unacceptable.
They see it as morally unacceptable.
It's
really?
morally unacceptable.
Wow,
it's not the way they want to do business. And, you asked me at the beginning of our conversation, how have things changed since, the late 90s when I started doing this work? And that's one of the things that has been a really significant change, is that you've got a lot of very large companies that are willing to do things simply because they know it's the right thing to do. We kind of, years and years ago, we had to make the business case argument, and it was a lot of work. But you get to a point where they get it, and they just want to do a better job. So they've been monitoring their supply chain, and now they'll come back to you and say, you know what, here's a problem. We can't figure out how to fix this. Excessive working hours, or student visas in China, or just all sorts of issues that come up. And we're engaging in this project here, and we're trying this experiment over here, and this doesn't seem to work, and this does, and what do you think? And it's really about, we just want to do a better job. You get a lot more companies that are willing to go there. That doesn't, I don't want to overstate the case. There's still plenty of problems out there, and plenty of companies that don't get that. But there's way more that do than there used to be. The nature of the issue has become so critical that you've really got a significant mass of companies that I think are digging in and trying to understand that stuff. But, they need encouragement. They need, sometimes the role that we can play, I think, is simply to serve as a catalyst or to encourage them to move in the right direction, because a lot of companies will worry, well, yes, I know this is the right thing to do. I think this will be good for our business. What will our investors say? This is a long-term investment. This may come at some short-term cost. Will our shareholders be okay with that? I think for them to hear from investors that we're encouraging you to do this, that we need you to do this, we need you to go farther, sometimes it provides the spark for the company that otherwise would not have done it. And in other times, it's more like, it's greasing the wheels for the company that would really like to do it, knows they should be doing it, but are worried that they're going to get a lot of flack for taking these steps. And so letting them know that the investor community, one, is not monolithic, and two, is changing dramatically, I think is useful, and to let them know that we do have a long-term focus, and we are thinking that broadly about these issues. Because then very often the companies are ahead of the investors, because they have to deal with these things on a day-to-day basis. Yeah. Their business to them is not abstract. To investors, it very often is. It's data on a screen. It's an abstract portfolio. It's not real world. That's certainly not true for the corporations that we're investing in. They got to deal with these challenges day to day. So I think sometimes it's refreshing for them to hear that investors are worried about those things too.
So now we get to the money question. With trillions of dollars already invested in ESG strategies and plenty more on the way, how can IROs work with people like Kanzer to shape the future? Well, listen up, folks.
I think that when the IR person sees their role as ensuring that the investor doesn't get to speak to anybody else, and sometimes I think that's the unstated mission that they're pursuing, that's not a constructive conversation. When I feel like I'm being essentially told to go away, they're giving me kind of pat answers, and I don't really feel like they're particularly engaged in the issue. Then they're simply giving me kind of a company line, and they're doing it so that I don't get to speak to anybody else. That's really frustrating, and that's problematic. And to be honest, if you have a really serious issue, if it's a pressing issue, and you can't get any traction, that's when investors start to look to other tactics, when they start to think about shareholder proposals or voting against the board, or because you can't get where you want to go.
How does a company typically hear from you? You call up the IR person and you say, here's our issue. How are you dealing with it? And, we'd really like to talk to, your line manager who's in charge of whatever it is, production. And then what would you like to see? What would be the ideal sort of response from them?
The answer to obviously it's going to depend on the issue that I'm raising, and I think there's a difference between calls from investors that are simply trying to get some information. I read the 10K, I read the proxy, I read your sustainability report. There's just a few gaps I need you to fill in for me. I'm a little confused about how this works or what this meant. Hopefully they can answer that question for you, and you move on. Thank you. that's great. But if you're calling because you're trying to advocate for a change in practice or a change in policy, you're probably not going to want to end up speaking to the IR person. The IR person might be a first point of contact. Sometimes it's the corporate secretary, sometimes it's the general counsel, sometimes it's the sustainability executive. But for me, if I'm talking about a supply chain issue, or I'm talking about climate change, or some broad issue where I really have kind of an advocacy goal in mind, the purpose of the call for me is twofold. It's one, to understand where the company is on this issue. Do they really understand it? Or are they grappling with it? Are they serious? And you can't tell if you're not talking to the person who's actually responsible for that work. If I'm talking to a third party, and the IR person may be a third party if you're talking about human rights issues in the supply chain, I mean, that's not their day-to-day job. They're translating from something else, and that's not really giving me what I need to know. If I'm speaking to the person that's in charge of that, and I get a strong feeling that this person's serious about it, they understand what they're working on, that puts me in a different mindset. Because now I know, okay, I don't necessarily have to push them so hard. I can ask for a few things, but this company is engaged and they get it. Very often the frustration for me is you get off the phone and I don't know. I can't tell whether the company either totally doesn't understand the issue or if it's just the person I spoke to is not the right person. You shouldn't feel that way. If you're speaking to an IR person and they know that, look, I'm not really the best person for you to speak to about this. I can't go very deep on this issue. Let me give you the basics, and then I'm going to put you in touch with so-and-so. That's helpful, because I want to know, on a supply chain issue, for example, I want to know that this person has actually been inside a factory. They know what it's like. They've worked with their suppliers. They know what the challenges are. They're personally responsible for trying to meet those challenges. If I'm talking to somebody who is tasked with purely communications, I'm probably not going to get that sense of confidence. I have spoken to some folks, though, that, if they get the issues, if they really understand it, they're in depth and they can really speak authoritatively. This is the company position on this. That's fine. We don't necessarily agree all the time, but at least I'm getting the answers to the questions I'm asking. But if it's ring fencing the whole thing so that I only get to talk to this one person, that gets frustrating very quickly. And that can sometimes be kind of obvious, and maybe the IR person doesn't realize how obvious that is. But sometimes it's quite obvious that you're just trying to get me to go away. Nobody wants to receive that message.
And that's your Ticker podcast for this week. My thanks to BNP Paribas Adam Kanzer. Maybe we're not all doomed after all. Visit IR Magazine's website for the latest news and insights from leading IR professionals around the world. Subscribe to the Ticker podcast on iTunes or wherever you get your podcasts. Thanks for listening. In Montreal, I'm Jeff Cossette.